Hey there, good afternoon. Welcome to SRT Live with me, your host, Sean Richard. What on earth are we going to see in the real estate market going forward and as the Fed continues to hike interest rates? That's what we're going to dive into today. So thanks so much for joining me. I'm excited to have you here. We've got a lot to cover as always, so I'm going to dive right in. And let's get into what's going on last week. So last week we had a healthy amount of information come out. As always, we got the jobless claims. As a reminder, if you're watching me for the first time, on Thursdays, we get initial jobless claims and continuing jobless claims. Those are unemployment claims. Initial is people filing for the first time. Continuing claims is people renewing their unemployment benefits. So last week, we got 218,000 new filings. Now, this is up from the previous reading of 197. Still very low numbers. Really, post-pandemic, we've really come down and settled into the high hundreds, low 200s range. And so that's keeping the employment environment really healthy, really robust. We're at a very low unemployment level. Continuing claims actually ticked down some. We actually came in at 1.317 million, down from 1.342 million. So again, just as it has been week over week, it's been speaking to the strength in the employment and labor markets. Now, we also got existing home sales, and that was on a month over month level. And we saw an increase of 5.61% month over month increase in existing home sales. And this is important because one of, if not the biggest challenge that we're facing in our industry is supply of homes. So we saw an increase in existing home sales, and that might be an indication that we're seeing a little bit more inventory. One of the bottlenecks that we've had is with such low inventory, we can't sell what we don't have. And so an increase in month over month existing home sales may mean we're seeing a little bit of an increase in inventory. Now, we also got housing starts, and this is the single family residence housing starts, just to give us an idea of where the building trend is going for the year. And so it came in at 1.724 million for the previous month. Now, that puts us on an annualized pace of 20 to 21 million, which is a very robust, healthy amount. We're definitely in a position where homes are going up at a reasonable pace. Comparatively, if we go back to 2010 to 2019, across the entire country, we had between 5 and 6 million homes put up. So that was a significant contributor to our current shortage of inventory supply. And so we're seeing builders put up homes, albeit with some challenges and some slowdowns. They're going up, just not quite as fast as the builders or home buyers would like them to. We're seeing a lot of homes that are stalling out in the middle of the process due to waiting on certain supplies, shower glass, appliances, garage doors, windows, brick. It's all coming in, just kind of trickling in. But we're on a good pace there. So let's talk about today. Not a big news day yesterday, but today we got new home sales. And this was, headline news. A lot of news stations probably covering this as a major negative, but came in at 591,000, down from 709,000 on new home sales. So that's a 16% decline month over month. And the previous month was actually revised down around 10%. And so let's dive into this just a little bit. So new home sales down. I just mentioned that we're seeing a long waiting period for a lot of new homes to be built, for all the delays, the supply chain constraints that we're seeing on products and materials to finish out these homes. And so that is likely the biggest contributor to the slowdown in new home sales. So it's something to keep an eye on as we hopefully start to see supply chain constraints expand and open up a little bit. we'll maybe start to see that number come back from negative to at least close to zero, and then maybe positive as we continue recovering from the pandemic. Looking ahead to the rest of this week, tomorrow, kind of a big day, we've got the Fed meeting minutes. And although Jerome Powell, Fed Chair Powell, had comments after the meeting minutes always give us a more granular look at what the Fed members are saying, what the details are, and it can be market moving depending on the nature of those comments and the meeting minutes. So it's something to keep an eye on tomorrow. And then, of course, Thursday, we get jobless claims. That's every single week, initial and continuing. And then we also get another GDP reading. Now, if you recall from a previous update, the previous GDP reading that we got came in at a negative 1.3%. We had a contraction. And the technical definition of a recession is 2 consecutive quarters with a negative reading. So we got a negative reading for Q1 previously, and this reading is a subsequent reading for Q1. So that's expected to come in a similar range, in that negative 1.3, negative 1.4 range. But we're likely to have a final reading of Q1 in the negative range. And so leap ahead a few months from now, we want to keep an eye on the GDP reading for Q2 to see if, unbeknownst to maybe some of us, we're in a recession right now. The market sure seems to think so. If you're invested in the market, it's definitely pricing in potential recession if we're not already there. Let's see, that was on Thursday, and then also on Thursday we get pending home sales. Now this was the reading last month was down 1.2%, and again, going back to a comment I made a moment ago, the inventory levels have been low and we can't sell what we don't have. And so I think that decline that we saw last month was a big part of heavily attributed to the inventory woes that we've been having. So we want to keep an eye on that on this Thursday. And then big number on Friday, we get the Fed's favorite measure of inflation, PCE, personal consumption expenditure. We both get the headline reading, and then we also get the core reading, which strips out food and energy. And the reason that we have that core reading that strips out food and energy is because the Fed feels like they have less control over food and energy costs. They can influence a lot of the other costs that go into that reading, the personal consumption expenditure, but food and energy, not as much. So they have the headline number that takes into consideration everything, and they've got the core reading, which strips out food and energy. So that's coming up this Friday. So big number there. So what are we looking to keep an eye on as we move forward in our housing market? So number one is we may be seeing a little bit of cooling in the housing market. Now, does that mean buying a home is a bad idea? And I'm sure you're going to have a lot of clients that are going to ask that question, or if you're a home buyer, you may ask yourself that question. And here's my take on that. So remember, for the past several years, we've been seeing appreciation in homes at an astronomical rate. Some of the most recent readings were up almost at 20% as a national average. Now, there are hotter markets and cooler markets. Arizona, Phoenix, ranging in the 30% range. Here in DFW, we're probably closer to the 8 to 12. Maybe some areas get a little bit higher, some areas a bit lower. But we've been seeing phenomenal appreciation in home values over the last several years. So what does that mean if the housing market starts to cool a little bit? Does that mean home prices are going to decline and we're actually going to see depreciation in homes? And I would argue that the answer is absolutely not. We're likely going to cool some, and that has to do with the fatigue that we're seeing from some buyers. We've got all costs are up. Rates are up, home prices are up. Costs of all other services and goods, and it's putting a lot of pressure on consumers. So we're seeing a little bit of fatigue in the housing market that may lead to some cooling off in the housing market. And that might bring appreciation down a little bit. But coming down from, say, 8 to 12% to maybe a 4 or 5% appreciation, very healthy levels that are sustainable. we've been at levels that are not sustainable over a long period of time. So seeing a cooling in the housing market and bringing those levels back to a sustainable rate would be a fantastic move and to see in the economy. So just know, if you're a home buyer, home prices are likely to continue to rise. They may rise at a slower pace than we've seen here recently, but that was bound to happen. And even if we end up in a recession, during most recessions, home prices still tend to continue to rise and interest rates tend to come down. So buying prior to the recession allows you to take advantage of the appreciation between now and then a potential refinance to get that rate back down to a little bit lower rate and reduce that monthly obligation is something that you can take advantage of when we see rates decline during a recession. So in short, still a really, really good time to buy. No fear to be had in going into a recession from the housing market standpoint, and still a great rate of return to be had on your home. All right, second thing, Fed rate decisions going forward. So we are expecting the Fed to continue to increase the Fed funds rate at least over the next couple of meetings. More than likely in June, we're going to see the Fed increase the Fed funds rate by 0.5%. Now, just as a reminder for you new to watching me, the Fed funds rate is the short-term interest rates. These are overnight lending rates between banks, and they are not a direct impact on long-term lending rates like mortgage rates. So they tend to have a bigger, faster impact on shorter-term products, credit cards, lines of credit, auto loans, things of that nature. But there is an indirect effect that they have, because lowering the Fed funds rate is designed to combat inflation, and inflation is the enemy of interest rates. As inflation rises, interest rates rise as well. So the Fed increasing the Fed funds rate is designed to bring inflation down, and we may start to see some calming of the interest rates as we head into the latter part of this year or in 2023. So meeting in June, we're expecting a 0.5% increase to the Fed funds rate. It's highly likely that we'll see another 0.5% increase in their July meeting. But we recently had Raphael Bostic, the Atlanta Fed leader, come out and say that he does support a 0.5% increase in June, a 0.5% increase in July, but mentioned that it may be appropriate to pause on the Fed rate hikes for their September meeting. Now, one Fed member by themselves with this view doesn't necessarily amount to a whole lot. However, if this starts to be a consensus among Fed members that they're going to pause on any additional Fed rate hikes heading into this fall, then that could mean that they've seen enough changes in the economy that we're moving in the direction that they want us to go, which again is inflation coming down, which would result in lower interest rates. So some really potential, some potentially positive movement and comments out of the Atlanta Fed leader. So we want to keep an eye on the Fed rate hikes in June and July and see what their comments look like heading into the third and fourth quarter of this year. So those are what we're watching for going forward in our housing market and the economy. I want to thank you all for joining me today on this episode of SRT Live with your weekly real estate market update. Remember, if you're watching this on the YouTube channel, smash that subscribe button. I don't know where it is. It's right there. Smash the subscribe button underneath there, so that way you can get this delivered to you on a regular basis. If you're watching in the Powerhouse Real Estate group, then thank you so much for being an amazing member of that group. If you're a real estate agent and you're not currently involved in our Powerhouse Real Estate group, make sure that you check out the email that you got and click on the link to go request invitation to the Powerhouse Real Estate group. We provide updated information on the market, tools, marketing tips, all kinds of great information to help you grow your business. If you have any questions whatsoever, reach out to my team, number right there, and we would be happy to help you take care of your clients and help you do more business. So again, thank you so much for joining me. I'm Sean Richard with the Sean Richard Mortgage Team here at Guaranteed Rate, and have an incredible rest of your